Not by a market crash, not by manipulation, but by something far more dangerous. Something happening right now. As you watch this, the silver lottery phase has begun. And if you don't understand what comes next, you'll lose everything you've gained and more. The pattern repeats every cycle. 1981, 2011, and now 2025. History doesn't repeat, but it rhymes. And the rhyme? It always ends the same way, with 90% learning the hard lesson, the expensive way. What is this invisible force that destroys wealth in plain sight? Stay with me, because what I'm about to reveal could be the difference between securing your financial future or watching it evaporate in weeks. Welcome to John Analyst, where we cut through the noise and deliver strategic economic truth. Now, I know you've been around the block a few times. You've seen trends come and go. You understand that real wisdom doesn't come from hype. It comes from pattern recognition. So here's what I ask of you, my friend. If you appreciate analysis that respects your intelligence, if you value warnings that could protect your capital, do me a favor, hit that subscribe button. Not for me, but for yourself. Because the insights we share here, they're not entertainment, they're economic intelligence. And before we dive deep into why 90% will fail, drop a comment below. Tell me, where are you watching this from? Are you in the States, Europe, Asia, somewhere else? I want to know. Because this pattern, it's global. Now, let's get into it. The silver lottery phase began the moment the price crossed $31 per ounce. Most traders didn't recognize it, but those who studied history saw it immediately. This wasn't just another price movement. This was the beginning of a dangerous psychological shift that destroys wealth faster than any market crash ever could. He had warned about this phase years ago, back when silver traded at $11, $15, $18, $22. Back then, the crowd wasn't interested. No mainstream media coverage, no viral social media posts, no excitement, just silence. But now, everything had changed. Silver was skyrocketing, and suddenly everyone was an expert. Everyone had an opinion. Everyone was jumping in. This was the lottery phase, and it had begun exactly as predicted. Years earlier, he made a public declaration, a line in the sand. Once silver crosses $30, he would stop investing for quite some time. People questioned this decision. They called it premature. They said he was leaving money on the table, but he understood something they didn't. The run from $30 to the all-time high of $50, it happens violently fast. He knew this, not from theory, but from experience. He had lived through it before, during the Great Recession era. He watched silver explode, then watched it destroy unprepared investors. The pattern was clear. The psychology was predictable. And history was about to repeat. But this time, there was a critical difference. During the Great Recession, the economic environment was deflationary. Prices were falling. Demand was collapsing. Fear was everywhere. Silver rose during that period as a fear trade, a safe haven, a bet against the system. But now, the environment was entirely different. This time, inflation was raging. Prices weren't falling. They were exploding. The dollar was weakening, purchasing power was eroding, and people were desperate for protection. This created a fundamentally different type of mania. The Great Recession silver rush was driven by fear of collapse. The current silver rush was driven by fear of devaluation, combined with greed for returns. Fear plus greed, the most dangerous combination in financial markets. And the media? They were pouring gasoline on the fire. Everyday headlines screamed about silver's rise. Every talking head predicted higher prices. Every social media influencer posted charts showing silver going to $100, $200, even $1,000 per ounce. The narrative became unanimous. Silver could only go up. This was the exact moment when markets become most dangerous. When everyone agrees, when there's no debate, when the crowd moves as one, that's when the trap is set. He remembered 1981 and 1982. The last time silver reached this level of mania, the price had skyrocketed to $50 per ounce. People were convinced it would go to 100, 200, even higher. Investors mortgaged their homes, took out loans, bet everything on continued gains, and then the violence began. Not upward violence, downward violence. Silver didn't slowly decline. It collapsed. Fortunes evaporated in weeks. People who thought they were rich on paper suddenly owed more than they owned. The pattern was brutal. The lesson was expensive, and most never recovered. Now, decades later, the same pattern was forming. Silver had crossed $42, then $45, approaching $50 once again. And the behavior? Identical. People were taking loans to buy silver. Others were putting their entire savings into the metal. Some were convinced the dollar would collapse tomorrow, next week, next month. They weren't investing. They were gambling. They weren't thinking strategically. They were thinking emotionally. And emotion in markets? always leads to the same outcome. The comments on social media revealed the psychology perfectly. I just bought $10,000 worth of silver. I'm all in. This is going to $100. Anyone not buying now will regret it forever. The dollar is finished. Silver is the only way. These weren't the words of strategic investors. These were the words of lottery ticket buyers. People who believed this one trade, this one metal, would solve all their financial problems. But lottery thinking doesn't create wealth. It destroys it. The silver lottery phase wasn't about the price of silver. It was about the psychology of the participants. And that psychology was about to be tested in the most brutal way possible. The question wasn't whether silver would go higher. The question was, who would survive what comes next? There was a fundamental difference between professional traders and amateurs. It wasn't intelligence. It wasn't access to information. It wasn't even experience. It was something far simpler. Professionals knew when to walk away. Amateurs believed walking away meant losing. This single distinction, this one psychological difference, separated those who built wealth from those who watched it disappear. He had developed a principle over decades of trading, a framework that seemed counterintuitive to most people. When an investment doubles or triples, that's not the time to celebrate and hold. That's the time to secure the win, pull back the initial capital, lock in the foundation, then let the rest ride. Most traders heard this advice and rejected it immediately. Their minds screamed, but what if it goes higher? What if I miss the biggest gains? What if this is the one that changes everything? These questions revealed the core problem. They were thinking like gamblers, not investors. A gambler believes the next bet will be the big one. An investor knows the game never ends, and survival matters more than any single win. Consider the mathematics, the real numbers behind the principle. Someone invests $5,000 in silver at $20 per ounce. Silver rises to $40. The investment is now worth $10,000. The amateur holds, waiting for $15,000, $20,000, $50,000. The professional does something different. He pulls back the original $5,000, secures it, removes it from risk. Now he's playing with pure profit, house money, gains that didn't exist before. If silver continues rising, excellent. He captures additional wealth with zero personal capital at risk. If silver crashes tomorrow, he's protected. His original investment is safe, and he can buy back in at lower prices. The amateur in the same scenario, if silver crashes, he loses everything, both the gains and potentially part of his original investment. He's left with regret, anger, and a painful lesson that cost him real money. But the principle went deeper than simple mathematics. It addressed something more fundamental, the psychology of winning. Most retail traders, especially in silver, had never experienced significant wins. They had small accounts, limited capital, and disproportionately large positions relative to their net worth. For many, a few $100s in silver represented months of saving. A $1,000 investment might equal 2 months of take-home pay. These weren't casual positions. They were life-changing bets. And that created a dangerous psychological trap. When someone with limited resources finally sees their investment double, their mind doesn't think clearly. They don't see it as an opportunity to secure a win. They see it as the beginning of financial freedom, the ticket out of their current situation. So they hold, they wait, they pray for more. And when the market turns, as it always does, they experience something devastating. Not just financial loss, but emotional destruction. The loss confirms their deepest fear, that they'll never win, that wealth isn't meant for them. This was the win deficit that plagued retail investors. They didn't know how to secure victories because they'd never had enough victories to practice. Wealthy individuals understood this instinctively. They knew that building sustainable wealth required a series of wins, not one massive bet. Each secured profit built confidence, created capital for the next opportunity, and reinforced disciplined behavior. This was the millionaire next door methodology. Not flashy, not exciting, but devastatingly effective over time. He had lived this principle personally, and it cost him in ways beyond money. For 13 years, he worked 7 days a week, full-time firefighter, plus a side hustle on every day off. Every dollar from that side hustle went into silver, not sometimes, not occasionally, every single dollar. His wife fought him on it constantly. To her, it was wasted money, money that could pay for vacations, home improvements, quality of life. The arguments were brutal. The stress was constant. The relationship suffered. Years later, when silver finally paid off, people said, "See, you were right all along." But that missed the point entirely. Being right didn't restore the lost time, didn't heal the relationship damage, didn't erase the stress. What would have changed everything? Learning to take wins along the way, doubling the investment, pull back the initial capital, show tangible results, reduce relationship stress, tripling the position, secure profits, demonstrate the strategy works, build trust. Instead, he held everything, waiting for the perfect exit, and paid a personal price that money couldn't recover. This lesson extended far beyond silver. The same pattern repeated in cryptocurrency markets throughout 2024 and 2025. He would identify promising positions, watch them rise 50%, 100%, 200%. He would suggest taking back initial capital, securing the foundation, letting profits run. And traders would refuse, convinced the next week would bring even bigger gains. Then the inevitable happened. The market corrected, positions collapsed, and those same traders were devastated. He watched it happen in real-time comments on videos from months earlier. Someone would write, "I invested based on your analysis 9 months ago. Still holding, still believe." But the opportunity had passed, the cycle had turned, and they were now underwater. The market didn't care about their belief, their conviction, or their need for the trade to work. Economic cycles never stop. They overlap. They evolve. They create new opportunities while destroying old ones. Every month, every year, every decade. A new cycle begins as another ends. Winners understand this. They adapt. They move with the cycle. Losers fight it. They hold losing positions. They wait for their turn, and they never recover. The silver lottery mentality was the clearest example of this psychological trap. People believed silver would bring them absolute financial freedom. They read comments from others. "I bought $400 of silver last year. Now it's worth $800. To wealthy observers, $800 seemed trivial. But to that person, it represented everything. Hope, validation, possibility. And that's precisely why securing that win mattered so much. If they didn't take it, if they waited for more, and the market crashed, they wouldn't just lose money, they would lose something far more valuable. The belief that they could win it all. The comment section had become a battlefield, not of ideas, not of intelligent debate, but of manufactured consensus. Something sinister was happening beneath the surface of silver discussions, and most traders couldn't see it. The social media landscape had transformed into a carefully orchestrated illusion. Fake voices, artificial enthusiasm, and strategically planted misinformation. And the average trader? They were drowning in it, mistaking noise for knowledge. He began noticing the pattern months earlier. Certain comments appeared too perfect and too polished, too consistent, no hesitation, no grammatical errors, no human imperfection, just flawless statements that sounded authoritative and convincing. These weren't real people sharing genuine insights. These were AI-generated responses, bots programmed to create engagement, to manufacture excitement, to drive clicks. The technology had become sophisticated enough that most couldn't distinguish between human and machine. And the people running these systems? They had one goal, not to help traders succeed, but to keep them watching, clicking, engaging. Because in the digital economy, attention equals money. Every view generated revenue, every click created profit, every share expanded reach. The truth didn't matter. Only the metrics mattered. He saw influencers with massive followings, hundreds of thousands of subscribers, posting content about silver daily. Their message was always the same: buy more, hold forever, prices only go up. But here's what most viewers didn't understand. These influencers didn't care about their own holdings. They cared about maintaining viewership, keeping the algorithm happy, staying relevant. If silver crashed tomorrow, they would simply pivot to the next trending topic. Gold, real estate, stocks, cryptocurrency, whatever generated views. Their financial future didn't depend on silver's performance. It depended on keeping audiences engaged. This created a fundamental conflict of interest that nobody discussed. The advisor's success and the follower's success were completely disconnected. One made money from attention, the other made money from correct predictions. These were not aligned incentives. The misinformation took specific forms, patterns that repeated across platforms. One narrative that exploded recently: silver batteries. Suddenly, every comment section filled with excitement about Samsung's solid-state silver batteries. This changes everything. Silver demand will explode. This is why silver is going to the moon. But anyone who researched beyond the headlines discovered the truth. Silver battery technology wasn't new. It had existed for decades. The recent announcement wasn't a breakthrough. It was incremental development of existing technology. And the commercial timeline, years away, maybe never at scale. But facts didn't matter when emotion drove the narrative. The same pattern appeared with solar panels. Comments flooded in. Solar panels need massive amounts of silver. Green energy revolution will consume all available silver. Supply shortage is guaranteed. Again, this wasn't new information. Solar panels had used silver for years. This wasn't a sudden development. The demand was already priced into markets, already understood by professionals. But presenting old information as breaking news created artificial urgency. It triggered fear of missing out. It justified irrational buying. It kept the lottery mentality alive. Then came the fabricated crisis stories. One particular incident revealed just how deep the manipulation ran. In December, as silver prices climbed, stories began circulating about a major bank collapse. The narrative was specific, detailed, seemingly credible. Bank X is failing due to massive silver short positions. They're being squeezed by the silver rally. Collapse is imminent. The comments exploded. People were convinced. Panic buying intensified. But he investigated, dug into actual financial reports, checked regulatory filings. The story was completely fabricated. No bank was in trouble. No crisis existed. It was pure fiction, designed to drive emotional trading, to create artificial momentum. And the source? AI-generated content, distributed through bot networks, amplified by algorithmic engagement. The technology had reached a point where lies spread faster than truth. Because lies were designed for virality, truth was just truth. This was the 80-20 principle of modern financial media. 80% truth, 20% critical lies. The truth made the content believable. The lies made it profitable. An AI system could analyze thousands of economic reports, extract factual data, then weave in strategic falsehoods. The output sounded authoritative, appeared well-researched, felt trustworthy. But that final 20%, it destroyed decision-making, led to catastrophic positions, ruined accounts. The tonality was the tell, the marker that separated human from machine. Human experts hesitated, used filler words, corrected themselves, showed uncertainty. Well, I think maybe it's possible. These verbal tics signaled genuine thinking, real-time processing, authentic uncertainty. AI content never had these markers. Every sentence flowed perfectly. Every transition was smooth. Every argument was polished. It sounded more expert than actual experts because it was engineered for persuasion. Not truth, persuasion. He recorded his content without editing. Raw thoughts, real-time analysis, genuine imperfection. Not because he couldn't produce polished content, but because imperfection signaled authenticity. The ums and ahs and pauses, they proved a human was thinking, processing, being honest about uncertainty. Meanwhile, the comment sections across platforms revealed another troubling pattern. The people most vocal about silver's inevitable rise were almost always newcomers. They had just entered the market. They had minimal experience. They had no historical perspective. But they commented with absolute certainty. Why? Because they needed to believe. Their financial situation depended on silver continuing to rise. They had taken positions they couldn't afford to lose. So they shouted down any cautionary voices. They attacked any risk warnings. They created echo chambers of false confidence. This wasn't a community of informed traders. This was a support group for people in over their heads, desperately clinging to hope. He had watched this same dynamic play out in cryptocurrency markets the previous year. Bitcoin at 60,000. It's going to 100,000. Ethereum at 4,000. 10,000 is guaranteed. Altcoins pumping 200% in weeks. This is just the beginning. And he kept repeating the same advice. Take profits. Secure initial capital. Reduce risk. The response? Mockery. Accusations of being weak hands. Claims he didn't understand the technology. Then the correction came. Bitcoin dropped 40%. Ethereum crashed 50%. Altcoins collapsed 70 to 90%. The same voices that attacked his caution? Silent. Or posting about lessons learned, or deleted entirely. And now, 9 months later, he'd see comments on those old videos. I should have listened. I lost everything waiting for higher prices. Why didn't I take profits when I could? The pattern never changed. Only the asset class changed. Real estate, stocks, bonds, commodities, crypto, it didn't matter. The psychology of mania remained consistent across every market, every era, every generation. And silver? Silver was no different. The lottery mentality had infected the space completely. People weren't investing. They were praying. They weren't analyzing. They were hoping. They weren't managing risks. They were gambling on miracles. And the misinformation economy? It fed on this desperation. Every bot comment, every fake story, every manufactured crisis, it all served one purpose. Keep them engaged, keep them trading, keep them losing. Because in the attention economy, losers generated more content than winners. Winners took profits and disappeared. Losers stayed, desperate for recovery, consuming endless content, clicking every headline, chasing every new promise. The system wasn't designed to create winners. It was designed to create engagement. And engagement always came at the expense of capital. The year 2026 was going to separate the prepared from the delusional. Not through dramatic crashes, not through sudden collapses, but through something far more brutal: volatility, unrelenting, merciless, wealth-destroying volatility. And 90% of silver traders had no idea what was coming. They believed they understood risk. They thought they had prepared, but they hadn't. Because understanding risk intellectually and surviving it emotionally are two completely different things. Economic cycles don't stop. They don't pause. They don't wait for anyone to be ready. One cycle ends, another begins, sometimes simultaneously, always overlapping. Monthly cycles, quarterly cycles, yearly cycles, decade-long cycles. All running at once, all influencing each other, all creating chaos for those who couldn't see the patterns. The professionals understood this. They adapted constantly. They never married a single position. The amateurs? They picked one narrative, believed it completely, and rode it into the ground. Right now, the silver narrative had consumed rational thinking entirely. The lottery mentality had reached its peak. He saw it in the comments, in the messages, in the testimonials people shared publicly. I invested $400 in silver last year. Now it's worth $800. To wealthy traders, $800 was irrelevant, barely worth noticing, but to this person, it was everything. It represented hope, validation, proof that they could succeed financially. That $800 wasn't just money, it was a psychological victory they'd never experienced before. And this was precisely why the next move mattered so much. If they secured that win, pulled back their initial $400, they would carry confidence forward forever. They would know, deeply, that they could identify opportunities and execute successfully, that confidence would compound, leading to better decisions, more wins, genuine wealth building over time. But if they held, waiting for $1,200, $1,600, $2,000, and the market crashed, as volatile markets always do eventually, they wouldn't just lose $800. They would lose something far more valuable. They would lose belief in themselves. That loss, that psychological damage, would follow them for life. They would never try again, never take another calculated risk, never build real wealth, because the pain of losing their one chance would be too great to overcome. This was the hidden cost of lottery thinking that nobody discussed. The financial loss was temporary. Money could be earned again. But the psychological scar? That became permanent. He had seen it countless times, across every asset class, in every market cycle. Someone would get their first big win, refuse to secure it, lose it all, then disappear forever, not just from that market, but from investing entirely. They would return to their regular job, their regular life, and never take another financial risk. The opportunity cost of that psychological defeat was staggering. Decades of potential wealth building, lost, because they couldn't secure one win at the right moment. But the lottery mentality was powerful, seductive, almost impossible to overcome without experience. The thought pattern was always the same. If I sell now and it goes higher, I'll have missed the biggest gains. Everyone says it's going to $100 per ounce. What if this is my one chance to achieve financial freedom? I can't sell. I might lose everything by selling too early. This thinking revealed the fundamental problem. They believed missing additional gains was the same as losing. It wasn't. Missing gains meant staying exactly where you were. No worse off than before. Actually, losing meant going backwards, destroying capital, creating real damage. But the lottery mindset couldn't distinguish between these scenarios. To them, not buying a ticket meant losing the jackpot. The reality? Not buying a ticket meant keeping your money, which is winning by default. Professional traders understood something amateurs never grasped. The market would always create new opportunities. Always. If you missed this silver run, real estate would present opportunities. Stocks would create openings. Crypto would rally again. The game never ended. Only the players who blew up their accounts ended. Survival wasn't about catching every move. It was about lasting long enough to catch the right moves. And survival required securing wins, banking profits, protecting capital. The coming volatility in 2026 would teach this lesson to millions. The expensive way. Silver wouldn't just go up. It wouldn't just go down. It would whipsaw violently in both directions. Up 20% in a week, down 30% the next, up 15%, down 25%. This type of movement destroyed leveraged positions, liquidated emotional traders, and bankrupted the unprepared. Those who had secured their initial capital, they could weather the storm, even profit from it. Those who were all in, they would be obliterated. He had stated his own position clearly, transparently, without hidden agendas. He wasn't selling his silver, not because he thought it would go higher tomorrow, but because he believed in long-term parity with gold. That was a decade-long thesis, maybe longer, based on fundamental supply-demand dynamics. But that was his position, his capital, his risk tolerance, his time horizon. It had nothing to do with what others should do. Someone with $400 invested, someone who had doubled their money, someone for whom $800 was life-changing, they should absolutely take their win, pull back the 400, secure the foundation, let the remaining 400 ride if they wanted, or take all 800, celebrate the victory, wait for the next opportunity. Both approaches were vastly superior to holding everything and praying for more, because prayer wasn't a trading strategy. It was a recipe for destruction. The advice seemed simple, obvious even, yet it triggered violent reactions. Comments would flood in, accusations would fly, mockery would intensify. Weak hands. You don't understand silver's true value. Paper hands always lose. This is terrible advice, but these comments always came from the same people. New traders, inexperienced investors, those who had never survived a real crash. They confused conviction with wisdom. They mistook stubbornness for strategy. And they would learn, eventually, after the market taught them. The question was whether they would have any capital left to apply those lessons. Most wouldn't, because 90% were about to get wrecked. Not by silver's price, but by their own psychology. The lottery mentality would destroy them. The belief that this one trade would solve everything, would create financial freedom, would change their life forever. That belief would keep them holding through the first dip, through the second crash, through the final capitulation. And when the dust settled, when the volatility subsided, when the cycle completed, they would be left with nothing but regret and a painful, expensive lesson about the difference between investing and gambling. Meanwhile, those who had secured their wins, they would be positioned for the next opportunity, the next cycle, next wealth building phase, because they understood something fundamental. Wealth isn't built on one massive win. It's built on a series of smaller wins, compounded over time, secured and protected along the way. That's the difference between sustainable wealth and lottery thinking. That's the difference between the 10% who survive and the 90% who get wrecked. The choice, as always, belongs to each individual trader. Secure the win or chase the dream. Protect capital or risk everything. Build sustainable wealth or gamble on miracles. The market didn't care which they chose. It would deliver the consequences either way. In 2026, with all its coming volatility, would be the judge. The only question that mattered now was simple. Which side of the 90% divide would they be on when the cycle completed? The answer to that question would determine everything.